Hey Fools, I'm Joel South. I'm here with Tyler Crow, Motley Fool contributor. Tyler, we're basically going to pick out three companies that have been on your radar. You're going to look at three smaller oil and gas companies, three companies that actually have had some cash problems. They haven't been as liquid as some people might like. We're going to look at Oasis Petroleum, Goodrich, and Magnum Hunter. What don't you like about these companies? What are you worried about specifically about these companies?
Maybe not like is a little bit strong, but some things I am certainly concerned about when I'm looking at these companies is, we're in a phase now where we're 3 or 4 years into the shale play. And granted, these companies are growing very, very fast in terms of production, but one of the biggest concerns of them right now is their capital expenditures are still are outpacing their production growth and their cash growth. And it's getting to the point where you're starting to see some real issues in terms of debt obligations. A lot of, for example, Magnum Hunter Resources right now, their cash flow, operational cash flow, is only covering about 7% of their capital expenditures right now, and it's been on the decline for the past 2 years. And all of these companies have actually seen a decline in their cash flow coverage of capital expenditures, which can be a concern considering that some of these companies have grown their production, 3 to 5 times over that time period. And what it leads to is the biggest concern is actually looking at, can they actually pay off these debts? A lot of these companies right now are all at junk bond ratings. If you look at right now, only Oasis Petroleum has a investment rating that's better than CCC, and every single one of them have an EBITDA to interest expense ratio of in the single digits. Magnum Hunter Resources is only at 1.22, so it's barely covering its interest expenses. And when you compare that to the broader independent oil and gas company space right now, almost the average for that space is more than 20. So it's getting to the point where you're starting to look at it and say, yeah, the growth looks great, but there are some concerns.
Yeah, I agree. If you look at a lot of these growing companies, I think a lot of people paid a little more for the assets originally, and it's kind of when you're manufacturing this type of oil, you kind of know what you're getting, so you can't, or the growth doesn't really offset some of the costs in a lot of cases. So I think with companies like this is a worry, and you have seen numerous other competitors, smaller competitors, have to go out and do smaller sales just to kind of cut down that debt. So I think that's something that you should be focused on here. And I think with any of these companies, if you only focus on the growth, you might be missing the whole story, because if they are if they don't have the liquidity to keep producing at that level, one earnings miss could really sink these companies. So I think just looking at the frontline growth is not the biggest story. You really have to look at their balance sheet over the long term.
Yeah, I think the only one of these three that I might give a little bit of a pass to right now is Goodrich Petroleum, simply because they're in kind of that transition where they were a natural gas heavy company and they're starting to move into that oil production. They've got their Eagle Ford acreage. They've got Tuscaloosa Marine Shale that they're going to start developing, which is looking very promising. I'm willing to give them a little bit longer window to evaluate this and see what's going on with those as they transition more to oil-heavy production and as natural gas declines. But it's still going to be on a tight leash, though, because, like we said, some of these metrics are starting to get a little scary.
I agree.
So moving on from, I guess you say, a little bit better news in the energy space, covering some of the bad ones, but one of the more promising sectors has been the companies that are involved in proppant, basically these stuff that they're putting in hydraulic fracturing, be it sand or ceramics, using it for opening up oil and gas wells. And we've had some companies in this space that have been going like gangbusters. So why don't you tell me some of who the players are and what's been going on with them?
Yeah, I mean, the big three players are US Silica, High Crush Partners, then also Carbo Ceramics. And really the two that I'm focused on is US Silica and Carbo Ceramics. If you look at just the amount of frac sand that's been used, it's really surging. It's actually increasing a lot higher than the rates for ceramic or resin-coated proppants, which traditionally I was a bigger bull for Carbo Ceramics because of that. And if you look at the reason this is the wells that they're drilling are using a lot larger laterals and more frac stages. And it's interesting, if you look at this chart here, you can kind of see where the average lengths of the average length, lateral length from different shale plays. And if you can see the Bakken, about the average is about 9,500 feet. And that's significantly higher, deeper than a lot of these other plays that you're looking at. And what I think that bodes well for, going back to Carbo Ceramics, most of the people in the Bakken are using the Carbo Ceramic or the ceramic proppant, and primarily a lot of people I've talked to said they prefer the Carbo type. And what this is helping them do is really continue growing at that 10% plus rate. So I think if you look at the Bakken and a lot of the growth that's still there, there's still a lot of growth for carboceramics. But going back to US Silica, this is also a company, I think all three of these could be winners over the long term. Obviously, they've outperformed a lot of the service companies because the growth has been so much greater. And just to show you how much the clients for a lot of these companies are using, carboceramics last year was saying their average amount of sand was about 2,500 tons per well. This year they're seeing that up to 5,000 tons, and it can also increase up to 8,000 tons. So, you're really seeing players go out there. Whiting Petroleum, they were saying that they were using about 1.5 million pounds per well. They said right now they're using up to 7 million. They're seeing a lot higher EURs from that. So they're getting that higher EUR, focusing a lot of their production in the areas, in the plays that they're getting that higher EUR. And I think this really bodes well as people try to get as much oil as you can right now when oil prices are high. So over the next few years, if you're seeing oil prices $95, $100, $105, I think a lot of the proppant companies are really going to take off.
Yeah, and to your point about carboceramics being the Bakken, it's kind of interesting. Based on the geology, ceramics seems to be really the name of the game when it comes to the Bakken. But in other places, you're looking at some of the places like in the Anadarko Basin where sand has been much more popular. And so, like you were saying, you don't necessarily have to pick a winner of all of these because each and every single one of them has that kind of special niche within shale plays that they could all really stand to benefit through this entire phase.
I agree, and I think the one thing that you will have to kind of focus on, which I think is actually kind of more of a bullish signal for the industry and especially U.S. Silica, is the supply is actually shorting. People are wanting that sand, but it's harder to find the actual sand wells or sand areas, and the states that a lot of the sand is actually being mined from, they're having a lot of people kind of speak out against it, where they don't want more traffic in there, so they are kind of limiting the supply. So I think the demand's going to outpace, which will help boost the prices and help boost the margins. So I see them as a pretty good way to play the service companies over the next few years. And I'll go back into kind of a company that you're looking at, looking at what's on your radar. There's a brand new company, traditionally or originally was part of National Oil Well Varco, one of their split-offs. What you know about them?
Yeah, I mean, we could say they're a brand new, but they've been part of National Oil Well Varco for quite a few years now. But they just got spun off on Monday. They go by the name of Distribution Now. They'll be trading under the ticker symbol, on the New York Stock Exchange of DNOW. And I think from an investor's perspective, this is completely away from its parent company now, so we get a real chance to take a look at the metrics and what it's going to do. And it's making it makes for an extremely unique investment opportunity in the oil and gas space, not just in the United States, but basically globally. And it's because it is a pure and simple distribution business. They're not a manufacturer or anything like that. They take all the equipment from National Oil Well Varco they've been manufacturing and selling, just saying, give it all to us, and we'll distribute it as needs fits. Now, the financials really won't wow anybody. I mean, it's kind of almost like retail. I mean, they have gross margins are less than 20%, and their goal is to have EBITDA margins of greater than 8%, which doesn't really wow anybody, especially in the oil and gas space when we're seeing, oil and gas producers with gross margins up in the 50, 60% range. So, but what intrigues me most is the trend that the company is looking at. The oil and gas supplies, the distribution of that is an extremely fragmented market. Greater than 50% of the market is spread out about over hundreds of players around the world. But this is a $50 billion annual revenue business. And right now, Distribution Now has about 19-20% of it right now. So there's a ton of room for this company to grow market share. And, as we saw at National Oil Well Varco, Chairman Pete Miller has moved over to the chairmanship of Distribution Now and walked away from National Oil Well Varco. He's been very, very good at identifying operational inefficiencies in the oil and gas market and bringing it up to speed. And based on that, I think there's a similar opportunity to make the distribution channels of the oil and gas industry more efficient, similar to what they did at National Oil Well Varco.
Yeah, I agree 100% on that. And I think there's two things that people should be focused on in this company. First off is, yes, they're selling all the NOV products that they had before, but on top of that, now that they're a separate business, they can start selling their competitors' businesses and really focusing on the people that are actually using it, so the other service companies and the other producers. So you're offering them the whole suite of products. And the way they're doing it, they're dropping their products at the locations that are needed. They track as they're actually used, and that's how they'll start selling. So I think that will start lowering costs for the producers, which will means more business for them. The other thing I think you have to know is when this company was spun off, they have zero debt. And as you talked about, this is a fragmented market. And if you looked at what P. Miller did at National Oilwell Varco, he bought a lot of companies, smaller companies, and basically moved market share up to, what is it at National Oilwell Varco, 50, 60, 70%. I mean, they have a huge market share of the market, and I think this business can do the exact same, and having no debt coming into it, I think, sets them up very nicely for that.
Yeah, I mean, I am a shareholder because I basically inherited shares as a shareholder of National Varco, but I'm certainly going to hang on and possibly add to that position because, like we said, P. Miller, he kind of had the golden touch at National Oil Varco, and I'm kind of I'd like to ride it and see how it goes.
I think it's a good way to do it.
And so moving on your radar right now, what is the biggest thing that you're looking at?
What I'm looking at is the actual production of oil in the United States. And I know that everybody's been talking about the bonanza that we're in, but just to know how much we're actually growing. And we just hit about the 8.5 million barrel per day mark. 16% year over year, and this is coming off of a winter of disruption. So I think the second part of this year, second quarter, third quarter, especially in the fourth quarter, you'll start seeing a lot more oil production. So can we hit what the EIA has of 8.42 million barrels per day? I think we can. What I really like about the production growth too is we're basically looking in 2015 to start producing as much oil as we ever have. We're starting to flirt with that level in the 1970s when we were producing over 9.5 million barrels per day. And a lot of that's still coming from the Bakken, Permian Basin, the Eagle Ford. If you look at Texas, the growth there was 30% in 2013 growth. North Dakota was up almost 30%. So we're still importing about 6 million barrels, but the new play that I think is going to start making up a lot more ground to get us to that level is offshore Gulf of Mexico. So that's where I'm looking at. I think there's going to be a lot of growth there. 18 plays are expected to open up this year into 2015. So I really like the Gulf of Mexico there. The company that I really like to play all of these is ConocoPhillips. They have excellent positions in all three of the plays that we mentioned, and they have great assets in the Gulf of Mexico, projects coming online. They're a company that has one of the highest or the highest dividend of any independent player. So I like their growth prospects. I like where the United States is going, and I think we can push that 9.5 million barrels a day. And I think ConocoPhillips is the company that continues to hit their margins. They're looking 3% margin growth, 3% production growth. I think they're on pace to beat that. So that's a company I'm looking at right now.
Yeah, and it's really hard to argue with ConocoPhillips, especially when you look at their unconventional oil production, which is in the United States on shale, on top of Gulf of Mexico. Basically, what they're saying is all of that production is better than $30 barrel per oil equivalent margins, which is absolutely fantastic. And if you can grow on that, I mean, that's a great foundation to be working off of.
On top of that $30 barrel that you mentioned, I also look at the amount of basically de-risked assets that they have out there. About 75%, I think it's a little higher than that, of all of their assets are in the OECD, so you don't have a lot of that international risk that you're seeing with some of the other big players. So I just think overall this company is in a prime position.
Great. Well, Joel, thank you very much for this. Thank you for watching, and tune into Fool.com for more insight and analysis.